Well, what is going on, everybody, and welcome on into the TC Trading Channel. So in today's video, we're diving into the art of a short squeeze. We want to dive into what goes into a short squeeze, how this all happens, how we can take advantage of that front side and the back side, and then, of course, how to know if it's too late. Because a lot of people are starting to get into, a lot of stocks that have a high short float, and they're thinking that this is going to go to $100 and it's a $5 stock and it's going to go crazy. But I think you need to kind of understand what's going on, and then how can you let the charts, the data, the trend, how can you let that all play out in front of you so that you actually know if you're putting yourself in a good risk to reward situation, if you're catching a short squeeze after it's already made a pretty substantial move, because we know they can keep on going, but they can also turn downhill pretty fast. So in this video, we're going to be going through some of the slides step by step with examples, and of course going back and forth to our broker so we can see the examples as they're happening. And then of course we'll talk about what's going on and how you can identify this stuff. And I would encourage you to take some notes. If you're someone who's new to this stuff, we're not just going to talk about, oh yeah, there's shorts in the stock and it just goes up and because they're covering and they're buying and they're getting squeezed. No, there's a lot more that goes into it. And I think especially identifying where shorts are in a tough spot so that you can continue to go long and take advantage of the long side. It's something that's helped me a ton in recent months as I started to identify this type of stuff. Now, okay, so in terms of ingredients, we need a stock. Now, not just any stock. For the most part, you're not gonna see Apple, short squeeze. You would need crazy outlier volume. You would need a ton of people jumping on into Apple all at the exact same time and smashing the market buy button for us to see anything kind of like that. But at the same time, there also aren't a lot of shorts in Apple. So that's really not your best candidate. You're looking for a stock that there's reasons to be short, whether that's bad news, whether that's a bad sector, whether they're overvalued, whatever it is. And you traditionally see this a lot in the small cap space, penny stocks especially, and then across the board, you can see it across other stocks, and we'll talk about some examples and why they happened and why the shorts were in the stocks and whatnot. But let's dive into this. If you don't understand short selling, what is it? And let's explain that really quick. I'm not going to read this off to you. You can look at this yourself. I'm going to explain it while you guys look at that if you would like. But essentially, you're betting on the stock to go down. Okay, so what do? Well, you sell shares short. And to do that, you have to borrow shares to then sell. And your intention is to then buy those shares back at a lower price. Sometimes there are fees involved, depending upon your broker. And sometimes there are hard to borrow fees as well that could be very, very pricey. So that really has an effect. But generally speaking, you only see those hard to borrow fees across very small cap stocks, crazy volume, outlier volume on the penny stock front. And there's a number of those, and we can talk about, well, we actually have one example here in this video that we'll talk about. But that's kind of what you have to understand when it comes to someone who is short selling. And some brokers, and a lot of brokers actually, a lot of basic brokers don't allow you to short sell. It's not the same as buying puts. That's one way to bet on the stock to go down, but short selling actually is indicated by shares. So this is, you're dealing with shares, you're not dealing with options, you are dealing with the shares of this stock. Now your intentions are for the stock to go down, but what's your risk? Well, technically speaking, your risk is unlimited because the stock could keep going up to infinity. As much as that sounds ridiculous, it's technically possible if you think about it. In theory, there's no cap to where a stock could go. So that's your downside risk there when it comes to shorting, which means the stock goes up. You want it to go down if you are currently short shares of a given stock. The next ingredient is buyers and a reason to buy the stock. If you don't have buyers and you only have sellers, then what's going to happen? Well, if someone's shorting a stock and you get more and more shorts that are coming in that keep selling shares, and then you have people who already have shares long that sell their shares and take profits or cut losses, the stock is going to come down. So you need buyers and a reason to buy. Okay, so we're getting a better understanding now. What is a short squeeze and how does that type of stuff work? Because it's not exactly just buying volume coming in or shorts covering. And I will take myself off the screen here in just one second so we can see this. But first, let's dive into the definition. So they specify a short squeeze here as an unusual condition. So it's not like it happens all the time. Not every situation of a stock going up is a short squeeze. And I think a lot of people in recent months have really confused that. And so I want to dive a little bit deeper here, obviously, throughout the video so you can get a better understanding as to what a short squeeze is, what isn't, and then, of course, how you can capitalize, because That's ultimately what we're looking to do. We can, information is cool, but we also want to be able to capitalize on the upside and the downside. We need an unusual degree of short sellers holding positions. So it's not like, you're going to see this in a stock like Apple for the most part, because generally speaking, are there a lot of shorts in Apple stock compared to, let's say, a stock like GameStop? There probably are a lot less shorts in an Apple stock, given its history and fundamentally speaking. Of course, that could change, but that's what you have to understand. There's a large degree of short sellers holding positions. Now we see that price start to push on up. Those shorts are like, what do we do? Here's where you can have a short squeeze really progress and develop and then ultimately play out in a very big way. All right, so I pulled myself off the screen so we can see this a lot better. Let's dive into what do we need to know. So a lot of shorts, those who have short positions in a stock, they're thinking it goes down, the stock starts going up. And why would it go up? Well, there's actually a lot of reasons why it could go up. There could be positive news. There could just be random buying volume that progresses, and all of a sudden it starts hitting people's scanners, because a lot of traders have scanners, especially in the small cap space. They notice when there's outlier volume, when there's unusual volume on a certain stock, on a daily time frame, on a minute-to-minute time frame, on an hourly time frame. That can be identified, and then people start to see what's going on here. Next thing you know, more and more buying volume comes in, everyone follows along, and that could be, that influx in volume. Or we could have kind of social media, which is a massive player, especially now and going forward from when you're watching this video. You can't doubt the power of social media when it comes to the stock market and short squeezes. It's going to happen. It's going to continue to happen. However, you're going to see that when social media platforms really narrow in on one stock, that's where it's most effective, because you're narrowing that volume in on one specific stock rather than spreading it out across multiple stocks, which is going to have less of an effect when that volume comes in. Now, shorts hit their stop losses. Okay, what do we mean by that? So think of it this way. If a stock goes below a certain level, let's say a stock is a $10 stock and it's at $10.25, let's say it's a $10.25 stock, and your stop loss is at $10. Say if this stock falls below 10 and starts to hold below 10, I'm going to get out. I'm going to put my stop loss at $9.95. Okay, if that's what you do, that's what you're doing on the long side. If you're buying shares or holding shares for the long side, looking for targets, maybe you're targeting $11, $12, whatever it is. Well, think of it the same exact way, just in reverse. If you're short a stock and you're shorting that stock, and let's say that stock is $10.25, you might have a stop loss at $11, or let's say $10.50. And so you put your stop loss there. Once the stock pushes above that level, your stop loss is hit and you're forced to cover, which means you're buying back those shares at a higher price. Ideally, you want to do it at a lower price to make money as you're short, but you have to make sure you protect your downside here, or really against the upside if you're going short a stock, and so you're forced to cover. Now, in addition to that, you have to also note that if you are not covering yourself, you don't put a stop loss, you don't take your loss, you could be taken out of that position by your broker. If you are leveraged into that position, or you don't have enough money to currently, afford where the stock is moving, they could take you out of that position immediately at any time, depending upon how much money is in your account and their rules and whatever their guidelines are. They could take you out. So you have to make sure you're aware of that. That's why if you're all in short, that could be very dangerous, because ultimately the stock may end up going down in the long term or in the next couple of days. But if today that stock pops up straight up and goes, let's say, from 10 to 20, and you have no money left, or your account is, pretty much zero, technically, or negative because you're short, even if the stock goes back down to 5 in 3 days, you can still get taken out on the day it goes to 20, get taken out at 20, and next thing you know, you're in trouble. And the same thing goes on the long side. If you're using leverage, if you're using margin, you can be taken out of a trade if the stock dips, and then only for it to recover and go higher, sure, the next day. That situation happened quite a bit in recent months, and so you have to make sure you're aware of that. So this whole process only enhances the buying pressure, and the stock shoots on up to the moon, as we like to say. Now, let's dive into some examples. We have GameStop right here, and of course, this is a great example, but we're going to talk about a different one that a lot of you probably haven't heard of, maybe, but we'll dive into that one here in just 1 second. That's next. So GameStop right here, ticker symbol GME. Well, what do we see? Late 2020 to early 2021, this stock was pushing up. We actually have December on the left-hand side of this chart, and then it goes all the way out to August. But the time frame we're focused on here is December through, let's say, like March and April, right? We had a lot of volume bars indicated on the bottom right here. And we have the price action up here pushing up towards almost $500 towards the top end of that range, which is kind of crazy. But back here at the end of 2020, short sellers were confident that this stock was going down because it was a dying business model. And especially during the pandemic, people thought, this is not going anywhere. And a lot of hedge funds, which that's big money, they have a lot more pull because they can really influence stocks because they have a lot more money to deal with. You're talking millions and billions of dollars for some of these hedge fund positions. You and your 100 shares of any stock is not going to make a dent into wherever they want that stock to go if they have that conviction or if they're making that move in that direction, right? So you have to understand that. But that's what they thought. So they're betting on the stocks to go down and looking to make some money. Now, we saw intense buying volume really pick up at the end of 2020 and into early 2021. And that was a lot in part fueled by social media, Reddit, Wall Street bets, and whatnot. This stock pushes on up, kind of consolidates here in that $40 range before making the next leg up from under $50 to up over $400 in late January, early February of 2021. That was intense buying volume. Take a look right here. We're talking about shares being traded in the hundreds of millions, 1 to 200 million shares on the left-hand side indicated being traded during that period, which was crazy volume because you go back, we weren't even anywhere near 50 million shares. Honestly, we're probably down under 20 million shares being traded on an average day for GameStop. And before that, maybe even less. So you're talking about insane buying volume coming in, which is outlier volume, as we like to say. Next example right here is Marin Software, ticker symbol MRIN. This is actually a more recent example in terms of the summer months of 2021. So what happened was there was news of an Instacart integration. They had a press release that came out to the tune of Instacart integration with their software. Now, the stock here is trading, we can see that, very little volume, well under 100 million shares being traded every single day, probably closer to the order of 1 million shares, not even. And then the stock pops up. We have a day right here before the news comes out, potentially, insiders, potentially those who have a little bit of an inside edge on the news coming out or something along those lines. Is it illegal? Yes, insider information is illegal, but do we know exactly what happened there? No, we don't. So that's what happened. Then the next day, we saw roughly 200 million shares being traded, and the stock was up roughly 100%. So stock's up 100% on that news release. Shorts piled in, knowing the history of this company, poor financial history. Go back to their earnings reports. They're not good. They're really bad earnings, at least in recent months leading up to this news release. The earnings reports were not good. Numbers going down, revenue, profits, all that stuff was down. Of course, there was a pandemic and stuff, but still they were not picking things up. So valuation-wise, as this stock pushed up into the mid to upper threes, valuation, fundamentally speaking, it just didn't make sense until they can start to back things up and prove with some bigger numbers and bigger increases in revenue and whatnot. And that would be something we'd have to see. And that's where a lot of shorts piled in, thinking it was an easy short. It was up way too much on kind of fluffy news. Well, what actually ended up happening the next day, the stock held up in the threes, held up, didn't die, didn't fade off, and the buyer stayed around. Then the next day after that, boom, the stock hit up 300 million shares. Crazy. Even higher the next day, almost 400 million shares traded in the next couple of days. This led to the stock holding up, continuing to squeeze shorts, and a 1,500% run in less than 2 weeks. So how do we identify a short squeeze? So we started to hint at it, right? With MRIN holding up, and even GME holding up after its initial pop up towards the $40 level. But not everything's a short squeeze. A big move in the stock price in a short period of time could just be fresh buying volume. What you're looking at, for example, with MRIN, if you go back here to this chart, I know I'm back on the screen, but if you go back here, you notice that it held up. It wasn't like the short squeeze necessarily happened in one day. That first day, a lot of that was fresh buying volume. The stock was down so low, not many shorts in their right mind would be shorting a stock as it's down towards the 52-week lows. It just doesn't make any sense. But after a stock makes a big move up, that's where shorts got in. So shorts started to get in here after that first move, and they never were let out of a trade. So we'll talk more about that and what that means here in a little bit. But you could have fresh buying volume and, of course, even thinly traded stocks with low floats. For example, stocks with under 100 million and even under 50 million. And there are stocks out there with less than 10, even less than 5 million share floats. You guys think about that. If you're someone with a trading account, or if you press market buy and you're trading with an account of $1 million and you market buy $100,000 worth, or even $1 million worth for people who have much larger to play with, you market buy $1 million, $1 million in Apple stock isn't going to do too much, but $1 million in a stock that has a 5 million share float that's trading at $5, that's going to move that stock, especially when you click market buy. So you could just see that type of stuff happen. It doesn't necessarily mean there's a short squeeze going on. But what you want to look for is those outlier moves, okay? Movement that significantly outpaces the recent price action. So what do we mean by that? That means that if, let's say, we're seeing a stock that's trading between, let's say, $10 and $10.25, if it's trading in that range the past 2-3 weeks, maybe let's say $10 to $11, it's trading in that range the past 2-3 weeks, 2-3 months, right? And maybe there's a trend in there. It falls down to 9 and it's bouncing back and forth between 9 and 10 or up to 12, right? It's roughly in that range, but day to day, you're not seeing crazy movement. All of a sudden, you see a day where now we have the stock making a move to $15, $20. That's outlier. That's an outlier move, right? That's now, okay, what's going on here? Was there news? What's happening? Were there a lot of shorts in this stock, or are shorts looking to pile in now? And if they are, can this be setting up for a short squeeze? Well, here we go. We're going to dive right into that right now. So how do you know when it's too late, or when you're on time and when you can jump in for that continued upside and a further squeeze? Well, we want to look at trends first. Is the stock holding trend? Now, we're going to look at an example here in just 1 second, but if it's not holding a trend, it's a little more difficult for that squeeze to happen. Are we seeing higher lows? Is resistance becoming support, and is that process repeating itself throughout the day or throughout whatever time frame you're looking at? So if you see a stock making higher lows, right, it's holding a trend. Let's say it's uptrending. And then you're seeing that, let's say that $11 area is resistance on the $10 stock. It gets to 11, it breaks through, pushes up to 11.25, comes back, and now all of a sudden it's holding $11 as support. Well, then you're starting to see that higher lows, resistance turning to support, and we're on trend. That's indicating that we still have more upside in the tank as long as that support and that trend continues to hold. We have key levels indicated right here. That's very much the same idea that we can dive into. So let's dive into some examples now. All right, so now we're inside the Webull platform. We'll leave a link down below to get some free stocks, 2 free stocks actually, when you sign up and deposit with the platform. Of course, you can use whatever platform you like. This is one we're going to be using here in this video. It's free to use, free commissions, none of that stuff. So, okay. This is a stock, BBIG, which is kind of happening live as we're filming this video. And of course, go back. Hopefully there's more to learn from on the backside or on the continued upside if we see more upside with this stock in the future. I highly recommend you go back and check out what happened here into early September of 2021 if you're watching this video after the fact. But we have some key lines. What are these lines? Well, we have this high back in here from early June. We draw a line right here. This is on the 1 year, 1 day chart. I like to start here, look to past highs. This also lines up with the high that we saw back in here early in 2021. Then we draw a line right here. This happens to be the highs from early 2021, back in January, okay? Then we zoom our way out and we start to get some more lines that we can draw on in. We have this line right here, which happened to be some highs we saw back up here in 2018. And then if you go all the way out, this 1059 is actually where we just hit up into pre-market hours a couple of days ago. So I have all those lines drawn in, and then we have even 1160 something. That's actually the all-time high, I believe, on BBIG. We have these lines drawn in, and if you take a look at the day that it started to make that squeeze, it held up, uptrending all day. Now, after that first day, how do you know it's going to continue to squeeze? Well, we kind of got a good sign of that the past 2 days, because look what happened, right? Stock push up, hit 1059, then pulled back, but we had these key levels already drawn in. So we want to see that these areas are holding up, or let's see how it respects these key levels. Well, the stock came down, came to this level right here, this 775 area, and it respected that level and bounced back up, only to get rejected up here towards that 950 as the market opened. Fell back off, didn't really respect this level too much. Actually, as it fell below, it ended up kind of showing resistance at that level right there, up towards that 765, and then it fell off, and it kind of started to fade. Then what do we see? It actually opened up and pulled back. It pulled back a bit lower than the 6, but it recovered quickly and then it reclaimed. So this is a good sign. It did pull back below, and there was a good opportunity to take this thing short from $6 down towards that 550, but then it bottomed out here and it got back up over 6, and then it started to hold up over 6 throughout the day, and it showed it reclaimed that key level. Then it started to push on up, and then it reclaimed this 765 area. And it held up over that in the after hours. And so we're watching to see how this one plays out in the next couple of days. does it keep pushing on up? So that's an example of those key levels holding up, playing out on the chart, zooming out, look at the broad picture, highs, lows, support, resistance, and then drawing those in, seeing if it lines up with the current price action. And of course, what do we see? The stock had resistance at that first key level up around $6. Guess what happened? We eventually broke above, and that 6 became support, and then the stock pushed on up since. And that $6 has actually started to hold up as support even now. So we're seeing these key levels holding on up, and that's a really good sign that this stock has more in the tank. Now I want to go back just really quick, okay? So we have this rule here, the 25% rule, and we have BBIG as an example. So I want to use this also as an example of this kind of ending. So we saw these key levels and we were looking for more, maybe up towards the 1165 area, but there's something called the 25% rule, which is by no means a rule you must stand behind, but I think it's a really good rough indication of what we're going to be talking about here. Are shorts going to get let out of a trade? We talked about that a few minutes ago too. What does that mean? And why is that important? Well, if we think about this, right? BBIG made this run from under $3 all the way up to over 10 in literally a day. So if you think about that and you think to yourself, okay, this thing went up. Yeah, it pulled back a few times, but these pullbacks were quite small. Take a look at this pullback right here midday. It was about an 11%, 12% is actually quite a substantial pullback, but it's not 25%. And we'll talk about why 25% is important. And where do we get that? We got that 25% after pre-market highs, dipping back down to that 770 area. That was a 27% pullback. That is an example of shorts potentially being let out of a trade temporarily. Why is that important? Well, if you take a look at what happened here on this day, the first day of the move, if you were shorting the stock, maybe you shorted the stock up here at that $6. That was a key level. That was a resistance in the past. Maybe you shorted it there. Maybe you covered some as it pulled back. Maybe you didn't, and you're looking for a bigger, pullback to the downside. Maybe you did, maybe you didn't. Pushes back on up, and it gets up here towards that 775 key level. Maybe you average it, you grab some more short. Let's just use 100 shares. Let's say, the max amount of shares you can go short is 300 shares, okay? You short 100 shares right here at that $6 area. You short 100 shares here at that 750 area, and now you're like, okay, I'm going to hold it overnight. You wake up, it's up near 10, you short another 100 shares up towards 10, and maybe your average now is roughly here in that 750 to 775 range. That's your current average. Well, the stock pulls back down to that range. It comes down to your average. What are a lot of shorts going to do? They're going to take off that additional addition of shares. Let's say that in this case, that third 100 shares, they may take that off here because it's a profitable trade on those shares, but now they can deleverage in case the stock does go higher as the day moves on, even though they're ultimately looking for a much bigger drawdown. So now they deleverage, now they have a little bit of powder. The stock pushes back on up, it gets up to that level, and it gets rejected here because a lot of shorts are trying to hammer this down with those shares that maybe they took off, or there could be new shorts as well coming in. So that's an example there of shorts being let out of a trade. Now, if the stock never pulls back to that degree and shorts average up, they could put themselves in a very difficult situation because if the stock never pulls back, at some point, they're either going to get margin called or the pain's going to be too big, that loss is going to be too big, where they're going to just have to take that loss. And that's kind of what we saw here in pre-market where the stock really accelerated its move to the upside and it pushed up over 10. So again, what do we mean by 25%? Well, that 25% was the opportunity for some shorts to average up and trim their positions, deleverage, only to be able to use that additional leverage now that they have to re-short, re-average in, and then play the stock back on down. So again, for that example, if their average is roughly around that 750, they take some off there, comes back up, they shorted up here over 9. Now their average maybe is back up towards 8. The stock, next thing you know, is back down towards 7, and they can cover for a profit on this entire trade, even though they originally started here shorting at $6. And you would think that they're dead wrong. Well, they were able to manage their way out of that trade, and experienced shorts know how to do this stuff. And ultimately, as that happened, you now have shorts in control, and the stock was down trading the rest of the day and then even into the next day until it started to reclaim. But in this case, right, there was plenty of opportunity for shorts to get out of this trade. At this point, right now, you're dealing with some stubborn shorts, or you're dealing with some who are now looking to get back in short after that move, and they're looking to get squeezed out right now. So now we're looking for the exact same thing to happen. Does the stock hold up, ever since it had that $6 support. Now, if it can hold this 775, and if it keeps putting in higher lows and it never has a really substantial pullback like we saw right back in here, this could certainly make another move to the upside, as those who are still short or those who are looking to reshort are going to get squeezed back out on the next move up. So again, looking for that big pullback. We haven't really gotten it here ever since the dip down to 6. We haven't really gotten it as of late. So we'll have to see if shorts can get in control, pull it back, get some of those shorts out who can reestablish control and play it back to the downside again. So there you guys have that. That's our shorts getting let out, and that's what we mean by that. Now, how do we take advantage of the backside, okay? Because like we said earlier, stocks like to take the stair-step pattern on up and the elevator down. So once the party ends, there could be some significant drawdown, and it can happen very fast, right? It can look like a cliff, just falling off a cliff, right? Now, we can play this a couple different ways. You can short shares or buy puts. Now, the problem with shorting shares here is many brokerage platforms are not going to have availability, especially if this is happening midday. If you're looking at a penny stock, a low float stock, and it's happening midday, you're not going to have availability. They're going to be saying, hey, we have no shares available to short. Sorry. Okay. More advanced brokers, you'll have better access to this. But basic brokers, for example, a Webull or even a TD Ameritrade, they're going to have trouble with that. Even E-Trade can have trouble with that. More advanced brokers that maybe cost more money are going to give you more ability to do that. On top of that, you can buy puts. Be careful here, because if you're buying puts, these puts on a crazy move are probably already going to be extremely expensive, and they're going to be factoring in a very large move to the downside. So in the case of these puts, I would look to deepen the money puts. They're going to be expensive, but make sure you know if you're targeting a certain dollar amount to the downside, make sure you know that that put is going to be at least this value by that point. And if it is, you'll be able to take profits even if it takes a couple extra days or a couple extra hours than you may have thought. The next way to play things is sell the news. If you're looking at a stock that's making a really big run up in anticipation of an event, a data release, for example, Pfizer had their FDA approval. We had a really big run in anticipation of that event. We got it pulled up right here. Pfizer pushing up end of July all the way into August, pushing up, hit 51, popped on up, FDA approval for their vaccine ever since that date. The 23rd, I believe, was the actual specific date. It has been downtrending. It pulled back from up over 50 down to 46, which for Pfizer's stock, that's actually a pretty significant pullback in recent days. So it's about 10%. So that's an example of a sell the news event. Many times the run-up is factored in beforehand, and the biggest telltale sign for a sell the news event is if we have an earnings report or an event and the stock has made a substantial outlier move. Okay, we talk about the outlier range, and it's made an outlier move in anticipation of that event, whether it's up or down. You're going to need a really significant event to change the direction of what's to come. So again, earnings report, this can be the same situation, running up in anticipation. Earnings comes out. If it's not blowout, knockout, completely knock your socks off, even beating the craziest expectations that were thought beforehand, if it's not going to do that, many times it's an opportunity for people to take profits and sell, and you get a sell the news event. There's also something called the 3-day rule. And the 3-day rule is actually really interesting because what you'll see is that a stock that makes a pretty big run pulls back, and then 3 days later, we get a pop. Now, it's not always going to be perfectly 3 days, but BLIN here is a good example of this at the end of June into July. Made a really good run, hit up to $14 on the peak. 3 days later, it was about 3-4 days later, the stock actually dipped on down, and then it had a nice pop. So if you take a look at this, from where it was down towards $6, it actually popped up 65+% up towards 10 in just one day, and then fell right back on down. But that's an example here of the 3-day rule, where generally speaking, after a big outlier move, give it roughly 2 to 4 days, and there's an opportunity for a pop as long as that stock is holding up on support levels. And last but not least, the 10% rule. What does this mean? Well, if a stock drops 10% in a given day, it triggers something called short sale restriction. Now, what does this mean? It means that shorts cannot short this stock into the bid. Okay, you have to short this stock on an uptick. This prevents these crazy kind of absolute cliff sell-offs from happening on a given day once a stock is down 10%. So if you have a crazy move, what we like to look for is if you're taking the opportunity to the downside and playing the backside, once a stock is already down 10%, make sure you're taking some profits along the way, because now short sale restriction is hit, and it is now valid for that day and the next day as well. Something you need to make sure you're paying attention to. So there you guys have it. I hope you got something out of this video. That is short squeezes in a nutshell. The art of the short squeeze. We dive more than just the nutshell, I guess. We dived a little bit deeper than that in this video. Let me know in the comment section down below your thoughts. Hit that thumbs up button if you like this video. And again, we have plenty of links and resources down below. 2 free stocks, TipRanks, research platform, Finviz, if you want to get access to a platform to scan for stocks that have high short interest. Finviz, link down below. There's a paid version. Free version works just fine as well. Check out that link. And as well, check out our other 2 channels. If you guys like the content here, good chance you like us on our other 2 channels. Thomas Caro and Stock Trends. Links will be down below in the description box for those as well. Thanks so much, guys, and we'll see you in the next one. Peace.